Sajjid Chinoy, head of Asia Economics at JPMorgan, joins in with a very interesting note that he has put out, which is essentially talking about India catching the Dutch disease and really comparing where India is standing right now in terms of the macro environment versus where we were in 2013. Remember, in September 2013, things were looking pretty bad for India, and we were on the verge of getting a possible downgrade from S&P. And from there, it's been a U-turn. But Sajjid, I'll let you, kind of give your opening remarks on what comparisons are you drawing, what inferences are you drawing, and why you've come out with this report right now.
Yeah. Good morning. Well, I think the first thing to recognize is, in the last month, you've seen a lot of contagion in emerging markets. You had Argentina being hit. The next week it was Turkey. Last week it was Brazil. So what you're seeing is that investors around the world are just treating emerging market countries, particularly those with a current account deficit, as one asset class, and they're not necessarily discriminating, amongst macro fundamentals within those countries. I think so. I think emerging markets need to be very wary and be on guard. I think the first point to recognize in India is we should not panic. I think our macro fundamentals are significantly better than 2013. So any comparison with 2013, is completely unwarranted here. The inflation today is running at 4%, 4.5% compared to 10% in the year leading up to 2013. India still has relatively elevated twin deficits, but they're still much below where they were in 2013. And we've seen the largest improvement of those deficits amongst the fragile 5 countries. And I think most of all, we've got significantly higher buffers here. FX reserves today, as a function of our gross financing requirements, are almost 1.5 times that they were in 2013. So I think the first point I want to make is there is no reason at all to panic. We're significantly more fortified than 2013. If there's one area we should, or two areas we should kind of just be wary of, it's that, below the radar, and that is the point we wrote the note, underlying external balances, the current account, India's current account deficit, adjusted for oil and gold, has worsened in the last 2-3 years. So in a way, all of the improvement in the current account compared to 2013 is because of lower oil and lower gold prices. So that's something we need to be very careful about, because if oil prices jump up or gold imports increase, those external imbalances will widen again. That's one. The last point I'll make is, I think amongst all of the different macro variables, we need to be a little bit careful on the fiscal deficit this year. That what you don't want is fears of fiscal slippage in the second half of the year, because what that might do is precipitate debt outflows, and that could put more pressure on the external imbalances. But keeping those two parts aside, the fiscal and the underlying external balances, India appears much more fortified than 2013. That was the kind of sum and substance of our note.
Yeah, indeed. And you stole my next question on that. So, Sajjid, in this current backdrop, as you highlighted, where there are concerns about rise in crude prices, there are concerns about current account deficit as well. Do you sense that these two could pose combined a risk for equity as well as debt flows into India?
I think at this point in time, if India were to prioritize macroeconomic stability, which is, I don't think we need to do anything fancy here. I think the lesson from 2013 was ad hoc policy announcements, actually betray nervousness and might generate panic. So when I hear instances of, India should issue an NRI bond, for example, or do something else, I'm not sure that's really warranted. I think we need to go back to first principles. And first principles are, we've got an institutionalized inflation targeting framework. I think a lot of foreign investors drew great comfort from the fact that the RBI last week raised interest rates and in a way confirmed the sanctity of the 4% inflation framework, inflation target. That's important because not only does it help anchor inflation in India, what it does is it anchors currency expectations down the line. See, the problem in 2013 was when inflation in India is running at 10% a year for 5 or 6 years and global inflation is at 2%, then you almost automatically expect that the rupee needs to weaken 7-8% every year. And I think it was that expectation that drove the panic in the rupee market. those concerns have gone away if India is going to focus on, you know, a 4% inflation target. So I think that's very kind of positive. Where we need to be a little bit careful, as I said, is on the fiscal front, because, you know, you've already seen a lot of bleeding in the bond market. Until recently, debt flows had not left the country because you were getting some benefit from the currency. In the last 2 months, as emerging market currencies have come under pressure, bond investors have lost money not just on bonds but on the currency as well, and you've seen, you know, meaningful debt outflows in the months of April and May. This is not just in India, it's across emerging markets. What we don't want is later in the year for there to be more pressure on bond yields because there are concerns that this year's fiscal deficit may slip. If that was the case, and you have, you know, a global environment which is not that benign, and there's some depreciating pressure on emerging market currencies, that's a pretty potent cocktail. I think that's the environment that we need to guard against, because that's what will drive a lot of debt outflows. But I think, you know, if we just go back to first principles, focus on macroeconomic stability, focus on hitting our fiscal target, focus on the inflation targeting framework, we'll be fine. Let me end by saying, you know, even if the balance of payments this year is in a deficit of $10 or $15 billion, that really shouldn't bother us. We have foreign exchange reserves of $420 billion. This is a war chest. If you have to run $10, $15 billion down in a year of global stress, that, you know, nobody should bat an eyelid.
Sajjid, rates are going up globally. We are looking at tighter liquidity conditions. So, you know, how does your report kind of highlight what we are staring at 6 months down the line, 12 months down the line? Because we will see rates between maybe closer to 2.5% in the US by then. We would see ECB stepping back on its QE program quite considerably, trimming down of the US balance sheet, and rate increases in response to what the Fed has done from a lot of emerging markets, including India. What would that mean for, you know, one's market positioning 12 months from here?
Yeah. So, you know, just look at what happened last night with the Fed. Not really unexpected. Our US economists have been saying this for the last year. We now expect that, you know, rather the median voter on the FOMC now expects 2 more rate hikes this year, which would mean 4 rate hikes in 2018. They expect 3 more in 2019. We think at some point that could get bumped up to 4 hikes in 2019. So we have to brace for the fact that global financial conditions around the world are tightening and will tighten meaningfully more. This should be no surprise. Global growth has been doing very well for the last, you know, 5 quarters, and a lot of slack has been eaten into, and so it was a matter of time before those ultra accommodative monetary policies began to tighten. What do we need to do in that environment? I think, you know, we have to accept the fact that interest rates in India may need to go up as well. One concern is that if you look at India's capital account last year, almost half those inflows were interest rate sensitive. You know, inflows into the government bond market, corporate bond market, ECBs, banking capital. And so this year, if global rates are rising more than Indian rates, the interest rate differential will narrow against India, and it's not clear whether we can attract that quantum of capital flows again, which we will need this year for to finance the current account deficit. So I think we need to, number one, brace for the fact that Indian rates may have to go up as well if global financial conditions tighten. And secondly, in the wake of higher global rates and a stronger dollar, emerging markets could come under some pressure, which is why it's very important here that this is the year we prioritize macroeconomic stability over growth.
Sajjid, very interesting note, and thanks very much for joining us this morning to discuss that.
Sure thing.
Take care.